You're a Bitcoin fan, I get it. But you are still wondering, why are the biggest banks and financial institutions on the planet pouring billions of dollars into Bitcoin, yet the price seems stuck, going sideways, or even dropping? You did your homework. You understood the scarcity argument. You watched the ETFs get approved. You saw the headlines about massive institutional purchases. And yet here we are, with Bitcoin not behaving the way any of this should suggest it would. Something feels off, and you're right to feel that way. Stay with me through this video, because by the end, you're going to understand exactly what's happening, why institutional buying doesn't automatically push prices up the way most people think it should, and more importantly, what you can actually do with that knowledge as an investor. Let's start with a question that sounds simple, but actually has a complicated answer. When a huge institution buys billions of dollars worth of Bitcoin, does that automatically send the price up? Most people assume yes. Basic supply and demand, right? But here's what people miss. It depends entirely on how they're buying it, and institutions almost never buy the way regular people buy. When you or I buy Bitcoin, we go on an exchange, we click buy, and we add upward pressure to the market. Simple. But when an institution is moving billions of dollars, they cannot do it that way without destroying their own trade. If you dump $1 billion into any market at once, you move the price against yourself. So instead, institutions use what are called dark pools, over-the-counter desks, and structured products. These are private transactions that happen completely outside the open market. The Bitcoin moves, but the public price doesn't react the same way it would if that same amount hit a regular exchange. This is one reason why you can see massive headline numbers about institutional buying, and yet the price barely flinches. Now let's talk about something that connects to this in a way most people aren't discussing. There's a real conversation to be had about whether any of this is good for the original vision of a currency that operates outside of traditional banking influence. And honestly, that tension is worth acknowledging. The whole point of Bitcoin for many of its early believers was to create a monetary system where no central authority could manipulate value. Yet here we are watching the same banks and financial systems that Bitcoin was designed to work around now becoming major players in its price discovery. That irony is not lost on a lot of long-term holders, and it's a legitimate concern, not a conspiracy theory. But here's the thing. Understanding how these institutions operate doesn't mean surrendering to them. It means being smarter than them at their own game. Let's talk about the company that is probably the biggest single factor in Bitcoin's current price behavior. Strategy, formerly known as MicroStrategy, holds an enormous amount of Bitcoin, well over 400,000 coins. On the surface, that sounds like a massive vote of confidence in Bitcoin. And in some ways it is. But the way they've structured their Bitcoin purchases creates a very specific kind of vulnerability that directly affects the price you see when you check your portfolio. Here's how it works. Strategy doesn't just use its own cash to buy Bitcoin. It raises money by issuing convertible bonds and preferred shares. These financial instruments come with obligations. The preferred shares have dividend payments that function very differently from regular stock dividends. Now, there's been some confusion about this point, so let's clear it up directly. Preferred dividends can in many cases be deferred depending on what the specific prospectus for each offering says. This is actually an important distinction because it means the situation, while complex, is not necessarily a ticking time bomb in the way some people describe. The terms of each individual preferred share offering matter enormously, and not all of them carry the same level of urgency or risk. That said, the broader pressure is real. When a company holds tens of billions in Bitcoin but carries significant debt obligations, the market prices in the risk that they might eventually need to sell some of that Bitcoin to meet those obligations. That expectation alone can act as a ceiling on Bitcoin's price. Investors and traders who understand this structure will short strategy stock or hedge their Bitcoin exposure because they're betting that selling pressure could come, and that activity reverberates through the broader market. This is what's called reflexivity in financial markets. The anticipation of a thing happening can create conditions that make that thing more likely to happen. You don't need a backroom conspiracy. The incentive structures built into perfectly legal financial instruments are enough to create this dynamic. Now, here's what you need to understand about altcoins in this environment. Because it's tempting to think that if Bitcoin is being suppressed by these institutional games, maybe the answer is to rotate into other cryptocurrencies. But this is where you need to be really careful. Bitcoin has something that most other digital assets simply do not have, which is a combination of first mover advantage, a genuinely clean launch with no pre-mine or insiders getting rich before the public, and a network effect that has been building for over 15 years. Most altcoins lack a compelling fundamental thesis that holds up under serious scrutiny. Network effects in monetary systems are extraordinarily powerful. The asset that gets there first and builds trust over time has an almost insurmountable advantage. Diversifying into speculative altcoins as a response to Bitcoin's price pressure is often just trading one risk for a much larger one. So what should you actually do with all of this? First, separate the price from the thesis. The question you need to ask yourself is not whether Bitcoin is up or down this week. The question is whether the fundamental reasons you believed in it have changed. Scarce supply, decentralized network, no central authority controlling issuance. None of that has changed because institutions are buying through dark pools, or because one leveraged company has complex debt on its balance sheet. Second, watch the signals that actually matter. If you want to track whether institutional pressure is building in a way that could create forced selling, pay attention to quarterly disclosures from major Bitcoin holding companies. Look at whether their cash reserves are shrinking. Look at their debt maturity schedules. These are real signals, not noise. Third, zoom out on your time frame. The people who have consistently made money in Bitcoin over its history have been the ones who understood the long game and refused to be shaken out by short-term volatility. The institutions that are engineering these complex financial structures around Bitcoin are doing so because they believe in its long-term value. You don't build billion-dollar positions in something you think is worthless. Here's the bottom line. Bitcoin isn't stuck because the institutional adoption story was wrong. It's stuck because the way institutions enter a market is messy, slow, and deliberately structured to avoid moving the price until they've finished accumulating. That might be frustrating if you're holding right now, but it's actually the most bullish signal possible when you understand what it really means. The most powerful thing you can do as an investor is understand the game being played around the assets you own, not to make you paranoid, but to make you patient. Patience built on understanding is completely different from just hoping things work out. So here's my question for you. Do you think Bitcoin eventually breaks through once institutional accumulation is complete and the selling pressure from leveraged holders clears out? Or do you think this structural dynamic becomes a permanent feature of the market that keeps Bitcoin range-bound for longer than anyone expects? Drop your answer in the comments below because I genuinely want to hear how you're thinking about this. And if this video helped you see something you hadn't considered before, please give it a like, hit subscribe, and ring the bell so you never miss our latest investing insights. These are the kinds of conversations that can genuinely change how you approach your portfolio, and I want to make sure you're always first to get them. See you in the next one.